Welcome to The Explainer. You know, the crypto world is completely infamous for its chaotic extremes, right? I mean, we've all seen the wild headlines, tales of overnight millionaires, and those spectacular, agonizing crashes. But what if I told you that the actual secret to building wealth in this highly volatile space is, well, predictably boring? Picture this for a second. You wake up a few years from now, check your phone, and a seemingly insignificant, mundane investment habit you started today has quietly snowballed into something pretty substantial. Sounds exciting, doesn't it? But getting there requires a major shift in perspective. So today, we're going to unpack exactly how that process works. We're stepping entirely away from the noise, the hype, and the frenzy to look at the foundational principles of building long-term wealth through consistent investing, specifically using Bitcoin as our framework. Let's dive in.
So let's just tackle the elephant in the room right out of the gate. Can Bitcoin actually make you rich? It's the quintessential question that brings almost everyone into this market in the first place. You see the charts, you hear the success stories, and honestly, it's super easy to get starry-eyed. But the path to actual sustainable wealth in digital assets is rarely what people assume it is. It's not a lottery ticket. To really understand the potential of this asset class, we have to strip away all that social media hype and look closely at the actual mechanics of how wealth is constructed and preserved over time. We've got to separate the fantasy of instant riches from the reality of strategic financial growth.
Look, we all know the days of snagging a whole Bitcoin for just a few bucks are long gone. And honestly, that creates a massive psychological barrier for new investors. People look at a 5-figure price tag and immediately think, well, if I don't have 50 grand lying around, I've completely missed the boat. But that couldn't be further from the truth. The most robust, resilient portfolios you'll ever encounter aren't typically built on massive, anxiety-inducing lump sum deposits. They're built on tiny, consistent seeds. You literally don't need a mountain of capital to begin. In fact, starting small is often the sharpest strategy out there. It lets you learn the rhythms of the market without risking your financial stability.
Now, we all know Bitcoin runs on a decentralized blockchain. You've probably heard it described a million times as a digital ledger. But let's shift our focus from what it is to the profound implications of what it means for your portfolio. In the context of long-term wealth building, that decentralization isn't just some tech buzzword. It is your ultimate security. Think about it. You are storing value on a global network of computers that is completely immune to central bank manipulation, corporate mismanagement, or government overreach. No CEO can just decide to dilute your shares, and no committee can vote to alter the fundamental rules of the network. That unparalleled level of sovereignty is absolutely the bedrock of this whole investment thesis.
And sitting right on top of that bedrock is, honestly, the most important number in all of crypto, 21 million. That is the absolute hard cap on Bitcoin's supply. Unlike traditional commodities like gold, where a massive spike in price immediately incentivizes miners to dig deeper or invent better tech to flood the market with new supply, Bitcoin's scarcity is absolute. It is mathematically enforced. There will only ever be 21 million coins, ever. It introduces a concept we have rarely seen in the entire history of economics: absolute finitude. When an asset is definitively scarce and global demand for it continues to expand, well, the fundamental laws of economics suggest its value has the potential to rise dramatically over a long horizon.
And that enforced scarcity, that is exactly why Bitcoin is increasingly viewed by institutions and everyday investors alike as a digital lifeboat. Let's look at the contrast for a second. While fiat currencies are constantly subject to the invisible, persistent tax of inflation, with governments effectively printing money and steadily diluting your purchasing power year after year, Bitcoin acts as a digital fortress for your wealth. It's actually designed to be deflationary by nature. In a world where the cost of living seems to just relentlessly climb, finding an asset that fundamentally resists debasement is an absolutely critical component of any modern financial strategy. It's really about protecting the time and energy you've already traded for your money.
But here's the really cool part. Because Bitcoin is a digital asset, it's inherently highly divisible, which completely changes the rules of engagement. We don't need to stress over buying whole coins. Instead, we stack sats, which is short for satoshis, the smallest fraction of a Bitcoin. This specific feature completely democratizes wealth accumulation. It means you can literally dollar vote your way into the network for the price of your morning cup of coffee. The barrier to entry has been totally demolished. Whether you are deploying $10 a week or $10,000, you are participating in the exact same network with the exact same mathematical guarantees, enjoying a truly level playing field.
But here is the massive trap that catches almost every single newcomer. We've all seen the crypto bros on Twitter or that viral video showing someone who supposedly made millions overnight trading some obscure meme coin. This instantly triggers massive FOMO, right? The fear of missing out. People let their emotions take the wheel, they panic that they're going to be left behind, and they throw their entire life savings into the market at the absolute peak of a hype cycle on a Tuesday. And then They are sweating bullets, staring at red candles, and entirely stressed out when the market naturally corrects on a Wednesday. Guys, that isn't investing. That's just gambling.
Instead of agonizing over timing the market perfectly, which is basically impossible, smart money uses a far more reliable tool. It's called dollar cost averaging, or DCA. It is elegantly simple, yet incredibly powerful. You just set a fixed dollar amount, let's say $20, and you buy on a rigid automated schedule. If the price skyrockets, you buy. If the price completely plummets, you buy. By relentlessly sticking to the schedule, you entirely strip the emotion and the guesswork out of the purchase. Over months and years, your cost per coin naturally averages out, softening the blow of high-price purchases with the massive bargain of low-price dips. As the old financial saying goes, time in the market always beats timing the market.
Honestly, the difference between long-term success and rapid failure in this space is almost entirely psychological. The emotional investor becomes a hostage to the one-minute chart. They are constantly reacting, buying aggressively during the euphoric hype, and panic selling the exact moment fear enters the chat. But the strategic investor, they operate on a completely different wavelength. They actually expect the dramatic 20% drops. They don't panic, they zoom out. They treat volatility as a feature of a free market, not a bug to be feared. By keeping their eyes fixed on a multi-year horizon, they just let the noise of daily price action wash right over them.
Okay, now, because we are playing the long game here, we absolutely have to respect risk. Let me be super clear about this. Bitcoin is incredibly volatile, and the digital asset space is not for the faint of heart. The golden rule of any strategic wealth building is to never, ever invest the rent money. You should only be deploying capital that you can comfortably afford to lock away and not touch for 3 to 5 years minimum. Furthermore, true financial resilience requires you to diversify. Bitcoin might be a phenomenal digital asset, but your overall financial life should be spread across multiple opportunities. You have to ensure that one single market swing doesn't capsize your entire future. Let's think about the remarkable power of compounding over time for a second. Just imagine 2 different people. The first person decides to wait 5 years, pinching pennies to save up a massive, perfect lump sum before they feel ready to finally enter the market. The second person abandons perfection and just starts today, deploying maybe $10 a week through automatic DCA. Thanks to the sheer power of compounding and early entry into a growing network, the person who starts today secures a massive mathematical head start. Waiting until you finally feel rich enough to start investing is an entirely backward philosophy, and it ultimately costs you your most valuable asset, your time. You know, there's an old investing adage that just hits the nail perfectly on the head here. The best time to start was yesterday. The second best time is today. The psychological hurdle of actually taking that first step is often the steepest part of the entire journey. We get paralyzed by analysis, waiting for the perfect dip or the perfect macroeconomic conditions. But the reality is, the exact dollar amount you initiate with matters significantly less than your genuine commitment to simply begin the process. Taking action, even in tiny, seemingly insignificant increments, will absolutely always outperform hesitant perfectionism.
So, what does the real wealth formula actually look like in practice? Well, spoiler alert, it is not some secret, heavily guarded trading algorithm, and it's definitely not insider information on the next hot coin. It is simply continuous, humble learning about the assets you are acquiring. It is responsible risk management that protects your daily livelihood. It's relentless, boring consistency in your purchasing habits. It means training yourself to think in decades and generations rather than days and weeks. And most importantly, it requires checking your ego and leaving your emotions at the door. If you can master these pillars, you fundamentally change your financial trajectory.
Which brings us to our final thought. The real question isn't whether Bitcoin is going to magically rocket to $100,000 tomorrow, or what the talking heads on financial news are screaming about for the next quarter. The real question is far more personal. Are you willing to develop the boring, consistent habits that actually build wealth over time? Are you ready to completely abandon those get-rich-quick fantasies and commit to a grounded, lifelong strategy that creates real, lasting value? Think about that deeply as you plan your next move. Thanks for joining me on this explainer, and I'll catch you in the next one.